Good morning, everyone from New York. Well, I should say good morning to everybody in the Western Hemisphere who's joining us, and good evening to those of you from Asia Pacific, and good afternoon to everybody else who's on this webinar. My name is Trish Mosser. I am the director of the MPA in Economic Policy Management at Columbia's School of International and Public Affairs, and I also head the school's initiative on central banking and financial policy. I'm very happy to be moderating today's discussion of monetary policy challenges in emerging market economies. This is actually the third session in SIPA's 2020 webinar series on central banking in the COVID-19 era that I have been organizing with Professor Takatoshi Ito at SIPA. We all know that the pandemic has created enormous economic policy challenges in addition to the public health challenges. And in response, central banks have taken quite extraordinary policy actions in the last 6 months. But the challenges, as usual, for emerging market central banks are particularly large. In addition to managing their domestic economic situation, of course, they are buffeted by an awful lot of external forces that make their jobs harder. We have a great panel to discuss this today. Leading off will be Ilan Goldfajn. He is the chair of Credit Suisse Brazil and the former president of the Banco Central do Brasil. The second speaker will be Urjit Patel, former governor and actually former deputy governor as well of the Reserve Bank of India. And he recently published a book, Overdraft, Saving the Indian Saver, this past summer. And last and certainly not least is Andres Velasco, Dean of the Public Policy School at the London School of Economics, former Finance Minister of Chile, and I want to say former faculty member at SIPA and in the PEPIN program. So it's great to see all of you. The discussant and questioner for today's panel will be SIPA's own Professor Guillermo Calvo, who I'm guessing really doesn't need an introduction since everybody knows Guillermo. So a few logistics. The panel is going to run until 9 a.m. Each of the speakers, I should say the webinar, excuse me. Each of the speakers are going to give brief opening remarks, after which Professor Calvo will give some comments and questions. And after that, we'll have time for a few questions from the audience. If you'd like to ask a question, please submit it in writing through the Q&A button at the bottom of your Zoom screen. So without further ado, I'll turn it over to Ilan. It's all yours.
Thank you very much. It's a pleasure to be here. Thank you, Trish. Thank you, SIPA, for that. And it's a pleasure to be here with such good friends in the panel. I'm going to make us a few initial considerations, and then we can go deeper in the Q&A as needed. First point I want to make is that this pandemic, this crisis, is very different from what we used to have. This crisis comes from outside the financial system, comes from a virus, from a pandemic, and it has a strong supply component. That means that monetary policy and the central banks have different weight for the roles. Liquidity is important at the beginning. Monetary policy at the deep of the lockdown is more important for rolling over debts, providing low interest to rolling over debts, than actually stimulating the economy that actually happens now in the post-pandemic. Second point I want to make is that the roles that I just mentioned give very different difficulties. First, liquidity provisions at this point were much easier. The problem was not liquidity, the problem was not the financial system. So most of the central banks basically gave a lot of liquidity. But the most difficult part was providing private and public financing. And this is very different. Liquidity provision, basically you give liquidity, but you do not assume the credit risk. Once you assume the credit risk, you have the default risk, either by financing the government or by financing the private sector. To do that, you do have to either have budget resources or be non-transparent and implicitly bear some fiscal resources. Third point I want to make is that we are now having, for some time, counter-cyclical policies in emerging markets. This is due to the new inflation environment, both globally and also locally in most of the emerging market economy, especially because we now have low pass-through. Even though you can have very large depreciation, it does not mean that you get high inflation in the countries. However, this cannot be taken for granted. You do need constant monitoring and credibility. We do have countries that, despite the global environment of low inflation, do have higher inflation and do have higher pass-through if they don't have the credibility, if the fiscal sustainability is at odds, or if the central banks are not taking monitoring very carefully. The fourth considerations are the relationship between fiscal and monetary. Fiscal considerations are always part of the central bank. If you have higher risks, if you have higher premiums, that enters into your neutral interest rates. If at the end there is fiscal dominance, that makes things much more difficult. But even if you don't get to the fiscal dominance, central banks have to take into consideration whether the fiscal is in order or not. And this is a major issue in the post-pandemic because most of the countries are much more indebted and will have much more debt, much more fiscal deficit. Now, there is a big difference between what we call QE in emerging markets and advanced economies. First, in advanced economies, QE usually happens when you reach a limit, which is a natural limit of zero interest rates, and you want to continue to stimulate the economy. In emerging markets, what we are seeing now is that you are trying to get, in some countries, QEs before getting to the lower bound of zero. And basically, because you believe that you in QE can actually give you some benefits in terms of simulating with less cost. However, as we all know, when central banks they increase their balance sheets, they on one side of the assets they have more assets, but on the other hand they have liabilities, and these liabilities in the emerging markets do pay costs. The cost is basically the short-term interest rates. So before you get into the zero lower bound, you're actually paying, and it's costly. And the big question in emerging markets, which is very different from advanced economies, is will the economy, will the agents hold the liability of the central bank in any condition? And that leads me to another point, which makes there's no magic, no free lunch. There are natural limits provided by either open capital accounts or free domestic financial markets. If agents have the choice to not accept any of the liability of the central bank, then there's a limit of how much QE you can actually do in emerging markets. That does not mean that at the limit, and this is the big issue people are asking, well, there's no magic, there are limits, people can actually take their money out of the country, people can actually take their money out of the financial system, but what if you really need at the limit to money finance your government? There's no other option. Then I think we are in a very difficult question, which are, will you adopt financial repression to actually get the financing? Because in the way emerging markets are now structured, in the way central banks are now structured, with credibility, with open markets, with no repression, it is very difficult to actually have this magic that if the country does not want to finance the treasury, it will actually finance the central bank by accepting their liabilities. So those are my initial remarks, and I'm ready here to answer any question in the Q&A. Thank you.
Urjit?
Yes, thank you. Thank you for inviting me to this panel. I'll make 3 or 4 sets of comments. First, I think there are some overarching considerations that inform or affect the discussions around the policy questions that are the subject of the panel today. First, to what extent realistically can demand side measures offset the the ongoing COVID-induced supply shock, which is first and foremost a shock on the supply side, which is the point that Ilan also made. Second consideration is to what extent central banks can substitute for governments who have primary responsibility to address the public health related risk. Third, concurrently, the world is also in the midst of elevated and possibly even increasing trade tensions. So the overall macroeconomic management is not just COVID related. Fourth, at least in some parts of the world, notably Asia, national security aspects have also suddenly come up. Fortunately for the global economy, advanced economies had the fiscal space, and this has been deployed generously. For the G4 and China, the headline general government fiscal deficit is running at around 16% of GDP. This has helped emerging economies on the real side as well, and there are now modest signs that exports from EMs are picking up. Furthermore, opening the liquidity sluice gates by the G4 central banks has in turn helped ease EM external financing constraints, especially for the larger EMs. In fact, as a sidebar, flows into some EMs are so strong that the trilemma has reared its head, given the speed with which the flows have come. So how are EM policymakers making decisions? I think they're doing so keeping in mind 5 things. First, the initial conditions with respect to availability of policy space, with respect to monetary policy, fiscal policy, and strength of bank balance sheets pre-COVID, that is before March 20. Secondly, they have to keep some ammunition dry due to uncertainty over the evolution of the pandemic and the consequent implication of keeping economic sectors going. Third, energy importing EMs have benefited from the collapse in oil price, and the choice governments have had to make is whether to pass on the benefit to consumers or tax away the difference and help the fisc. Fourth, an EM currency by definition is not a reserve currency. We know from experience that global flows are fickle, so policy risk aversion is understandable. Fifth, and which is related to the fourth, is if reputation for prudent macroeconomic management wanes, then flows will be affected. From the past, we know that sudden stops have been disruptive. So the trick is flexibility without losing sound macro anchors. And this means that prioritization and timelines of policy support are important, especially given the uncertainty on the time span and concomitantly the depth of the public health shock. On the fiscal side, the EM's overall increases in general government deficits from the previous year have been comparatively modest. For the group as a whole, around 3% of GDP, essentially comprising of higher subsidies, cash transfers to the most vulnerable, cheap food, and some amount of automatic stabilizers that have been allowed to play out, at least in some countries, on the taxation side. On top of this, there have been some loan guarantees and other backstops. EMs have relied more on monetary policy as they entered this phase with limited fiscal elbow room. On balance, the success of keeping inflation more or less under control pre-COVID allowed EM central banks to aggressively cut policy rates. And in several economies, real policy rates are already negative. And so far, inflation seems to have been relatively muted in most EMs, but these are early days. EM central banks, excluding China, have expanded their balance sheets this year by about 5 percentage points of GDP, including support for official spending. In a way, a limited, constrained, or less pure form of so-called modern monetary theory has been practiced, perhaps, as it used to be in diverse countries in the past. Markets have welcomed, indeed through governments may have to an extent led central banks to relax the inflation mandates. The formal relaxation is designed to impart credibility to the lower for longer policies that are now being followed. However, even helpful constrained discretion during emergencies requires guardrails. At some point, the same markets will demand a sharper spelling out of both messages and mechanisms of the new stance of central banks, and EM central banks will be held to a higher bar, make no mistake. One suspects that this will happen at the first sign of inflation picking up when it does, and the unwinding of central bank balance sheets will become a dominant form for any. This is likely to be asynchronous, as domestic rebound from the supply shock will vary from economy to economy on the evolution of the pandemic within borders and the response to it by governments in terms of further lockdowns. We must also keep in mind the political support for further policy action. Countries like the US and UK, just to take two examples, which expanded generous income and credit support, are now confronted with the reality of the public health shock persisting longer and the question of what more can be done with political support. The uncertainty on this aspect, combined with the resurgence of COVID infections and the potential of renewed strict localized or intermittent lockdowns, is now an important backdrop in the coming months for all economies emerging and developed going forward. I'll stop there. Thank you.
Thanks so much. Andres.
Thank you, Trish. Thank you for the invitation. Delighted to be here. Back at Columbia, where I was a student, or where I still have many, many friends. An honor to be joining this panel with two eminent central bankers. You know, I'm just a former finance minister, so I don't get to do this thing very often. But now that I'm not a finance minister, now that I'm back in academia, I want to play the academic in this discussion, although Guillermo, I'm sure, will do the same thing, and ask, what is it that we understand and what is it that perhaps we do not understand about the elephant in the room? I think the elephant in the room is, how much policy space do emerging market central banks have to do the kinds of things that the big boys, you know, the ECB, the Fed, the Bank of England, have been doing since 2007, 2008. Once upon a time, when we, everybody on this call used to teach monetary and macro to undergrads, we used to say that there was something called the monetary base. We used to say there was something called the money multiplier, and the money supply was a product of those two things. And we used to tell students that in the long run, if you double the money base, you double the money supply, because the multiplier was more or less constant, and you would also double the price level, right? Those were, kind of bread and butter undergraduate monetary theory. Turns out that, at the time of the great financial crisis 12 years ago, the Fed balance sheet went up by a factor of 4. Depends exactly how you measure it, but let's say that the money base went up by a factor of 4, and the price level did not budge then, and did not budge pretty much at any time since the big financial crisis. So, you can do a lot to M and not much happens to P. And the question is, well, what happened? Where did our models go extraordinarily wrong? If you ask that question to central bankers, they'll give you a bunch of answers, but one answer they will give you is, oh, but you don't really understand. We have changed our way of operating. And what we do, or at least what we did in the aftermath of the world financial crisis, is that we now pay interest on reserves. So we create all this liquidity, but then banks don't just limit their holdings at the Fed to required reserves. They hold lots of reserves that they don't have to hold there, and this keeps the whole thing under control. One way of thinking about this policy is due to Ken Rogoff, which reading his stuff has helped me understand this. Ken makes the point that when the interest rate is 0, both the real and the nominal interest rate, money and bonds become perfect substitutes. So what's really happened in a lot of advanced economies is that the fiscal and the monetary authorities have become one. I mean, there always were one, but now the link becomes tighter. And what central banks have done in the rich world is basically issue a lot of short-term debt. And they're paying interest on reserves. Now, I was a student at Columbia in the 80s, and I had the privilege of taking not one, but about 4 terms of macro, closed economy macro, open economy macro, with the eminent Professor Guillermo Calvo. And I learned lots of things from Guillermo, lots of theories, lots of phase diagrams, lots of transversality conditions. But if I think about policy lessons that were applicable to emerging markets, and of course, policy lessons that emerge from his abiding and never-ending interest in his beloved Argentina, you know, if somebody pressed me, what did Calvo tell you? 2 things that central banks should never do. I would say, never pay interest on reserves, and never print a lot of money and then mop it up, sterilize it using very short-term central bank bonds. Because the first one opens you up to very nasty dynamics, and the second one opens you up to multiple equilibria, because one good day, people may decide they no longer want to hold those very short-term central bank bonds, which is, of course, something that's happened to Argentina many times, happened to Argentina 2 years ago, and it may well happen to Argentina again. Guillermo will tell us in the next few months. So one way of expressing my puzzlement is that rich country central banks have been doing exactly what Guillermo taught me one should never do. And the reason why rich country central banks get away with this, maybe, and this is where I would like to invite you to engage in some discussion and tell me maybe that I'm completely lost, is that we live in this very unusual world in which the interest rate is 0. Both nominal and real interest rate, and in which, if Blanchard were here, the real interest rate is way below the rate of growth. So you can engineer that odd thing that we economists like to call bubbles. You know, you can issue debt and not necessarily have to raise taxes in the future to retire that debt. So central banks in the rich countries have gotten away with that. It seems to be the new normal. They've been doing it for 12 years. And of course, they're engaging in a new bout of exactly that medicine today. What's changed? What's changed is that, as Ilan and Urjit just said, since coronavirus in the last 6 or 7 months, EM central banks have been doing exactly the same thing. And they've been, to some extent, able to get away with it because conditions are not exactly those in the rich world, but they begin to resemble the rich world in the sense that interest rates worldwide are, pretty much 0. Institutional credibility is a little bit stronger. As Ilan said, many years of low inflation have lowered the pass-through, so movements in exchange rates don't immediately go to prices. And as Urjit said, we're not seeing QE, we're not seeing unorthodox central banking in EMs of the magnitude we saw in rich countries, but we're seeing a bit of it. And when I ask myself, what are the limits to this? My immediate hunch is to say, I do not know. And I'm wondering whether the eminent central bankers on this call have a firmer or wiser answer than I. For at least 2 reasons, and so sorry to keep coming back to this. First of all, because when you issue a lot of central bank debt that is very short, as Ilan asked pointedly just 5 minutes ago, you never know how long market participants will want to hold it. You can imagine a story in which expectations are such so that everybody does, but you can also easily imagine a story in which expectations shift, nobody does, you have a run, and that run is based on expectations that seem self-fulfilling. And of course, the whole thing holds together to the extent that the world keeps on having very, very, very low interest rates. I have no idea whether that will be a permanent feature of the world economy forever. Certainly people who bet on interest rates going up over the last 12 years lost a lot of money, at least they didn't go up on a sustained basis. So maybe demographics and productivity and other underlying factors are such, and of course Olivier would tell you that that is the case, we will live with interest rates that are 0, even in real terms, maybe even negative in real terms for a long time. And as a result, EMs are not on such treacherous and dangerous ground. But let me just emphasize and end here, Trish, by saying that given the magnitude of the pandemic, it seems to me that we all have to be bold. So I'm very, very happy that EMs are doing what they're doing. Central bank in EMs are doing what they're doing. But let me also emphasize that I suspect the foundations for the stability of this policy are weak. There are probably other equilibria out there, and whether we will end up in one of the good ones or one of the bad ones, I do not know, but it is something that we should be pondering. Let me stop there.
Thank you. Thank you, all three of you. And now I'm going to turn it over to Guillermo.
Well, thank you very much to the participants. Really, the issues that you have raised are very exciting, and I'm very sorry already that we only have 1 hour to debate them, and I'm sure we will have to do it again and again. Talking about the strange things happening now in the world, referring to what Andres mentioned, if you look at the Switzerland, I mean, the puzzle is even worse because Switzerland's money supply, base money increased by 16 times since the Lehman crisis, and prices are flat.
Right.
So now, I think one big issue is we are trying to understand from a very macro point of view where we are at this point. And that's why I prepared one very short presentation that I'll see if I can share with you. So this is how I feel what's going on. When the crisis started, if you remember, I mean, I'm talking about the COVID crisis, the emerging markets felt there was a very strong pull taking funds out of those countries, capital flight, an enormous capital flight that we haven't seen before. That was the end of the world. And then a couple of weeks after, things changed completely. By the way, we keep talking about the COVID crisis as a supply side crisis, and it is true. Now, from the standpoint of many emerging markets, the crisis really became very serious just at the beginning, and not for health reasons. It was this enormous capital flight that everybody feared it was going to destroy emerging markets. Well, as I said, that didn't happen. And one possible, and I think realistic explanation for that is what happened to the Fed's balance sheet. So you see that the balance sheet increased during the Lehman crisis about 7% percentage points of GDP. And this time around, in a much shorter period, it went up by around 15% of GDP. So in my view, this made a big difference. This allowed emerging markets to follow counter-cyclical policy and have the problems, quote unquote, that Andres has mentioned, like we don't see inflation. In fact, we saw inflation in Brazil, I think for 1 month or so, deflation in Colombia, which was totally unexpected. In all of the previous crises that we have seen, I mean, going back to the Russian crisis in 1998, what happened in emerging markets was some increase in the rate of inflation. And in 1998, the increase was quite substantial. So this is the first time where several countries, and some countries that have fiscal deficits which are not insignificant, like the case of Colombia, exhibited negative interest rates, no, I'm sorry, negative rates of inflation, and even consider pushing the policy rate of interest to negative territory. So one possible explanation for that is a reflection of this huge increase in liquidity coming from the Fed. Now, let me show you the last slide. As you know, I've been obsessed with the notion of sudden stop. In sudden stop, you don't look at stocks, but at flows, right? So if you do the same picture that I showed you before, using flows, this is what you get. And then using the techniques that we use in our work, you sort of identify sudden stop as a situation where the flow falls more than 2 standard deviations. And there you see this line is 2 standard deviations. So what you see here, just by looking at the flow, is that during the Lehman crisis, it's a huge increase in the flows. Again, because of the Fed following these proactive policies. But then, around 2008, after the crisis ended, there is a big shift in the opposite direction. So big that it qualifies as a sudden stop. So now we are here. What do we see? We see, yeah, in line with what we were discussing, the increase in the flow is quite substantial, much, much bigger. And after, again, not only bigger, it happens within 2-3 months as compared to 1 or 2 years in the previous crisis. So the question that arises is, what's going to happen now? We are going into a new period where we hear already that everybody is beginning to talk about the post-pandemics, where there is some debate in the US whether they are going to continue with this stimulus package, maybe stopping it. Nobody knows. But one cannot discount the possibility that this collapses. By the way, we are looking at flow. So this could happen even though the stocks reach a plateau. So it's not that they're going to undo that sort of thing. So that's a question that I thought it was interesting for this discussion to put on the table, so to say, or on the screen rather, as a reference. If this were to happen, then you would have a slew of sudden stops, and that would be a problem. And now I want to address the issue of policy going forward. There are 2 sorts of policy. One policy that you have dealt with so far here, and I have a little to say, is the policy for individual emerging markets, right? Now, if you have a phenomenon like this going on, then all of a sudden you have a slew of those. Then you have a systemic sudden stop. And for that, you need some global monetary authority of some sort. We are not well prepared. We knew the importance of those from previous crises. We talked about a lot, and I don't think we have Taka in the panel. He knows much better about these issues. My view is that we are not prepared. There's been a lot of talk in the G20, but we don't have the institutions to take care of this. And we are discussing on standstills and stuff like that, debt standstills and so on. But I haven't seen anything really that the World Bank, for example, had done anything beyond what they already have. So that's why I'm concerned. I feel that we don't have the instruments if that were to happen. Now, I don't want to take more time. Let me just say a couple of words on the policy to follow. I think this business of kind of a new monetary world where even emerging markets can have access to expanding money supply for fiscal purposes without creating big inflation. I think that's something that we cannot discount. We are there. And the question is, should we take advantage of that? And taking advantage of that would be, for instance, that countries, instead of going outside to fund their fiscal deficit, that they just print money. I don't see why not. I mean, you can get, just to give an example, because otherwise it would take hours, you can get a line from the fund, and the fund has been very generously expanding those lines, but you don't need to spend them. Some of the fiscal expenditure these days, unfortunately, reflects efforts to transfer funds to the least privileged of society. You don't need dollars for that. You need pesos. So why don't you start by transferring pesos, care a little less about the fiscal deficit, and if it turns out that the wave starts changing direction and inflation threatens, you have the funds available to then borrow. Otherwise, you may be getting yourself into a foreign exchange problem, so to say, without really the benefit of it, and missing the chance of using your own money when one of those few times when it's still worth it. Thank you.
Thank you. Whoops. Thank you very much, Guillermo. Okay, so who wants to start in response to that? So two major questions. One, obviously, about the risks that all of this is going to go bad when the flows slow down, which they already have, at least in the U.S. And then sort of the more generally, is this such a bad thing to take advantage of this in emerging markets? I think those are two fantastic questions. Ilan, you want to start, go in the order where we were before? That's fine.
Yeah. Let's say that I think those are great presentations and great points. I will say I'm a bit more concerned about the way things are going in emerging markets. I think we do have limits, and the last graph of Guillermo is quite important. I do think that there will be some sudden stop at some time, and that will limit not only foreign funds, but the availability of very cheap funds domestically. Unless you have closed borders and financial repression, which was my last point, agents will always look at the risks, look at the funding, and decide whether they want to roll over this very short-term debt. What central banks are doing in emerging markets, in practice, as Andres mentioned, is issuing short-term debts. And when you issue short-term debts and you have a sudden stop, it's a big issue. It's a big problem. I think there is complacency now for good reasons, as you all say. Interest rates are very low globally. You do have funding. You do have a lot of debt on the other side. And worse, you do have a lot of deficits. So as Guillermo mentioned, if you do have a sudden stop, which is a flow, even though you still have to roll over your stock, you still have to finance these big deficits that are still going to be there because the emergency loans to the unprivileged are still there, and it's going to be very difficult to take them out cold turkey. And that's what's the debate here in Brazil, for example. You cannot take them cold turkey. So my take is that central banks, unfortunately, still have limits, especially in emerging markets, especially because you don't have zero interest rate yet, and especially because fiscal risks are very high. So whoever is buying your debt knows the risks and knows that there's high risks. So my policy advice, if I could say, is take it easy. Don't take all the opportunity you think you have in the short run, because things are longer and things change very rapidly.
Right.
Please.
So I mean, I'll echo what Ilan said. I think there are two things that that can mitigate the impact of a sudden stop. One is that when the money comes in, build up self-insurance, add to reserves, try to avoid, if not a nominal appreciation, at least a real appreciation of the exchange rate, because that also gives confidence to investors that you know your exports will be competitive and you'll be able to service external debt. And the second one is to message that that the monetary and maybe also the fiscal authority will be flexible when the difficult times come. You stand ready to reverse what were extraordinary measures that were taken, in particularly, you know, borrowing at the short end. I don't know whether it matters whether the central bank does it or the government. The dynamics will be the same. There will be a lot of pressure not to raise short-term policy rates, but that plus the inflation mandate of the central bank needs to be messaged that the authorities stand ready to reverse these things in a calibrated manner. So these two are self-insurance policies. One is tangible, quantitative, how much you add to reserves when the money comes in, and the second one on verbal and past policy credibility. I think these two things can help. I think on average the EMs have been circumspect. The danger is actually to listen to some people who know better, who should know better. I don't want to name them, but they happen to be in Washington. That you know, you can that the EM should borrow, and then let's fight the war, and we will you know, pick up the pieces in the future. I think that advice so far most EMs have not taken. It should be taken with a tablespoonful of salt, and if the circumspection continues, the likelihood that we come out on the other side with less collateral damage to EMs, the better it is. I also think that in terms of the flows, I think the Fed has also learned from the taper tantrum and what happened in 2018, that some amount of weightage on the financial conditions of EMs when financial flows have been so generous, and maybe a highly calibrated approach, again a flexible one. So if things do look problematic as they did in 2018, then there is some sort of closed loop policy over there. I'll stop there. Thank you.
Please, Andres.
Thank you. Well, I find this whole exchange fascinating. I have to say that, you know, if I had been sitting at the helm of a central bank like Urjit and Ilan have, I would also probably share their concern / prudence, because it is clear that we are treading here on uncharted terrain, and it's very, very easy to get it wrong. But I'm tempted to ask, let's just try to maybe dig a little deeper and ask ourselves, what are those constraints, or where might the limits lie? Ilan said one thing which is important and which I share. If your fiscal situation is very bad to begin with, then this game is probably not for you. And I suspect, Ilan may have in mind a large Portuguese-speaking country on the Atlantic coast of South America. Surely, when you're running when you had a fiscal problem to begin with, and when your gross public debt is 100% of GDP, which is exactly where Brazil is going, it's natural that you should be wary of very bold and unorthodox monetary policies. But suppose your public debt is not 100% of GDP, but 28% of GDP, as it is in Peru or Chile, for instance. In that case, having put the immediate fiscal menace aside, where do the limits lie? Guillermo is saying something which I think is fascinating. He's saying, look, there may be demand out there for your money, or for these short-term central bank bonds, which are very close substitutes to money when the interest rate is 0. Test that. Coming from an Argentine, that's a very bold statement. But he's not stopping there. Guillermo, correct me if I'm wrong. You're saying, if you are Peru or Colombia or Chile, you have access. First of all, you have central bank reserves. And secondly, you have access to fairly ample IMF liquidity. So provide contingent backing. Print these pesos, and if suddenly people are going to dump the pesos, then ring up Washington, say, send me some dollars, and then exchange the pesos for dollars. So it's an interesting policy because it is a monetary expansion, but with sort of, I guess a theorist would say, with some commitment as to what you would do in a sort of off the equilibrium path. If all hell breaks loose, then call Washington. It seems to me that may be worth exploring because, again, given that there's probably a whole number of equilibria out there, and we don't quite know what takes us from one to the other, maybe not in Brazil, Ilan. I don't know about India, but maybe in other somewhat better behaved EMs, there is a bit of room for doing what Guillermo is suggesting. Last but not least, I want to take off my hat as an academic and a student of monetary theory and say something about the politics, because as my wife likes to say, I'm a reformed politician. 10 years ago, one could claim that the management of the crisis was pretty bold, and nonetheless, the political fallout from that crisis has been very, very, very nasty indeed. Lehman Brothers didn't quite give us Donald Trump and Mr. Orban and Mr. Duterte and Mr. Bolsonaro, but there's probably some link there. So when putting things on the balance, yes, there is some, if you're a central banker today in an emerging market, there is some risk that if you are too bold, things could go haywire. But there's also the risk that if you don't act boldly, you could end up with political consequences that are so nasty that beloved institutions like an independent central bank may go down the drain in a very populist and very demagogic environment. And that's a very hard trade-off to even think about. Central bankers don't like to think in those terms, but I suspect it is a trade-off that we should be thinking about. If fiscal and monetary policy did not act very boldly in this particular mother of all crises, if the politics in the world has been bad over the last decade, it could get much worse indeed, as the countries we come from attest to very, very clearly. Yes, and that includes you too, Patricia.
Oh, yes. Oh, yes. So, Guillermo, would you like to respond? And then we can take a couple of the questions that are in the
We'll continue for a long time.
Oh, I'm sure.
That line, let's stop it. momentarily, at least as far as I'm concerned. But there is another question that I have for this panel, and that is the role of national banks, national development banks.
Mhm.
Here we have two representatives from countries where those countries, those banks have played a very important role. Brazil, in the first place, I'm thinking about the Lehman crisis.
Mhm.
Apparently, in Brazil, they made a difference, and it's debatable and everything. That's why I would be interested in your opinion, Ilan. And certainly also the case of Andres, Chile. But then the question is, suppose, well, now you have a bank, which, by the way, by its very nature, when you talk about independent central banks, it becomes questionable. What do you mean? You have a very large, the bank in Brazil is one of the largest in the world. And they are playing side by side with the central bank. So I don't know how that thing works, and whether one can dare to say that the central bank can afford to be independent. But that's one question. And then that's one issue. But an issue that is probably more general is if you have those banks and you have a sudden stop kind of crisis, which is we are all concerned about, are those banks the right instruments or institutions to be in the front lines, or should be the central bank? And why do I ask that? And I discussed this a lot with Andres, because the National Bank, Development Bank, is focused on development, long-term projects, and so on. The central bank in this situation has to be focusing on very short sort of assets. Liquidity is at the center. So if you want to use the national bank, maybe it's not that well prepared. So, but I don't know. And I'm very curious if you want to comment on those issues.
Well, I can start on Brazil. I don't think our experience with BNDES is Banco Nacional de Desenvolvimento Econômico Social, which is it's very big. It has funding larger than the World Bank, and we actually did not get more investment as a percentage of GDP. We probably got more crowding out in the last few years. I think the question with the national development banks looking at other experiences is whether they're going to be lending at market prices, or they're going to be subsidized. And if they subsidize, whether they will be crowd out private sector market. And the other question, which Guillermo was asking, what is the role during the crisis, during the moment you actually need them? I think if they can have a role in completing some of the markets in moments where markets are not working properly. But it's very hard then to just, after that, just leave them in your, okay, now you're over, just go back home. Market is working properly again. We can lend long-term market rates. They usually overdo it. It took Brazil a long time to get BNDES to work at market rates. Now you have a booming capital markets. Even with all the crises, you have capital markets grow at 100% growth every year, which is basically companies paying BNDES with the domestic funding they have. But I do see there is a role during crisis when markets do not work. And the question is how to have this mechanism and don't have all the trouble in the good times. That's what I think is the issue at this point. And just finally on the big issue that Andres and Guillermo mentioned is, should we take risks now? And I agree, when you don't have a fiscal problem, like in the case of Brazil, should central banks take more of these risks or not? I think it's clearly an open question. But one issue I just want to raise is that if everybody does it, we do know that everybody will run for the IMF at the same time. So we must know that if we're going to do that, it must be a general lender of last resort there with enough money to give the lender of last resort to all the countries that need the resources at the same time. So that I'm not sure we have. We are debating now during the pandemic the resources of the IMF, if they can do it, and it's not there yet.
Reactions from anyone else? Urjit?
Yeah, I mean, India does not have any longer development banks owned by the government, but 60% of our commercial banking sector is accounted for by government banks. And even pre-COVID, we had NPAs that were comparable or in the company of Italy and Russia. So I mean, the moral hazard and the lack of sharp commercial incentives when there are government-sponsored lending institutions, that trade-off is substantial, and therefore whether that conduit for long-term large lending is something that needs to be thought of very thoroughly, because there is, in fact, when you have government-owned entities, you have what I call aggravated moral hazard. It's not just the sort of background low equilibrium moral hazard that is there everywhere, but when government owned lending institutions, the lack of commercial incentives to make decisions so that the money comes back is so blunted, especially when government already has a reputation for recapitalizing at the drop of a hat. So I would find that highly problematic. There was a good reason why government-owned long-term development banks faded away in most countries, and much of that was because they ended up with very large non-performing assets or bad debts.
Absolutely.
Yeah, I guess it's a difference. I understand, and I have the same feeling about misgivings about national banks for all the imperfections that they imply. So there is no disagreement there. But now we are in a situation, we are here, that's where we are, and we are what we are. And we may be facing a sudden stop situation or complicated financial situation. That was what was behind my question, and I noticed that sometimes, I mean, I'm always a little worried that something happened to central banking. They became kind of too religious for my taste. All of these years of, say, normality until recently, we developed the new Keynesian models with very strange assumptions that do not apply in situations like this. And central bankers are the first ones to know that they don't when it happens. But the tradition is there. In some countries, like I found out in Chile, they were terribly, the central bank cannot buy treasury bonds. Whereas now I look at the numbers for the US, 93% of the treasury bonds that were issued in the first 2-3 months of the pandemics were absorbed by the central bank. Enormous amount of money. And it was perfectly reasonable because otherwise there wouldn't have been the mechanism. So I'm a little concerned that we may, especially emerging markets, are the little boys that had to follow the big guys do. So, and that's what what's behind my comment.
So thank you. That's really good because that gives me a chance. If we can steal 5 extra minutes, if the panelists are okay with that. One of the questions, by the way, several of you brought up some of the questions already, so that's good. We're not going to answer all of them, but we've answered quite a few. That's a good news. But there is a very big picture question, and it goes along with tradition or quote religion, to Guillermo's point, which is, what does this all mean for inflation targeting? Practically every central bank on the planet, certainly all the large emerging market economies and advanced economies, have inflation targeting regimes. Is that something that ought to be rethought in light of the last, not just the last 6 months, but the last 12 years? Since it includes, as Guillermo rightly put it, a bunch of assumptions that for probably 3 of the last 12 years haven't really been applicable. I'd appreciate everybody's views on that.
I'll say something about that, and then defer to the central bankers. Well, Guillermo brought up religion, so let me continue along the religious line here. I have a friend in South America who says that Latin America has taken a very Catholic approach to inflation targeting, meaning, of course, that Catholicism is about doing one thing and then saying that you're doing something else. You know, inflation targeting as contained in textbooks for a while has not been practiced in most countries, among other things because, you know, pretty much every country that is an open economy intervenes in the foreign exchange market. Some do it more systematically, some do it less systematically, some do it following rules, some do it following discretion, but in some sense, pure inflation targeting went out the window a while. Now, should it go out the window entirely and for good? Not necessarily. Perhaps what we need is, you know, a set of rules for tranquil times and a set of rules for crisis times. I think for tranquil times, if those times ever come back and we go back to the office and all of that, you know, I think the performance of inflation, you know, flexible exchange, inflation targeting with occasional exchange rate intervention has done okay. But for non-tranquil times, it is simply not enough. And as Guillermo pointed out, the very central banks that invented it, you know, advanced country central banks, not just the Fed and the ECB, think of, you know, of the Riksbank, think of all the smaller countries, Canada, New Zealand, Australia, and so many others. They've all thrown the rule book out the window when they needed to. And I see no reason why emerging market central banks should not do exactly the same thing.
I have a view on inflation targeting less pure from the beginning. I don't think any emerging market since the beginning did not intervene. Intervention in forex exchange always happened since they were invented. Emerging markets always constructed reserves and always intervened. So I think what Andres is saying is that this is there, and it's the way emerging markets have done. I think the big question is not whether you go back to a pure inflation target that was never there for emerging markets, but whether you have these windows, as Andres mentioned, where you actually be even more flexible than usual, and whether not doing so, it's more a sign of religion, as Guillermo is pointing out. The question with emerging market is that in order to have these windows, you need to have some preconditions. If you are just a recovered addict and you just need to drink a little bit, it's going to be very, very difficult, the consequences for the long term. So it's not an issue of being religious and not drink, it's that you don't want to drink because you know what's going to face you the day after. So I think the issue here is what are the conditions? And as I mentioned before, it could be the case that we do have emerging markets that have the condition to open. Maybe Peru or Chile, as Andres mentioned, but it's clearly not, I think, a general prescription for emerging markets. Most of the emerging markets have a lot of volatility, have a lot of issues. They are not for free that they're calling emerging markets, that have large risks. So I do believe that some emerging markets can upgrade and do other stuff like the advanced economies. But I don't think it could be a general prescription for all emerging markets.
I had mentioned that how much any central bank, but in particularly an emerging market central bank, has been able to do and possibly will be able to do in the midst of the COVID crisis is where you started off. I mean, the initial conditions are important, and that includes also for all three sets of policies. And the economic variables are inflation, relative external stability, and a capitalized banking sector. And to echo Ilan, very few have pursued corner solutions. In fact, it's very difficult to do that. So you have had fair bit of exchange market intervention under the guise of reducing large volatility. The inflation targeting regimes have been flexible, and bans have been given. And remember that the credibility that was obtained during those times is what has allowed the elbow room to be used. And you don't want to end up where the elbows get broken. So no one has been straitjacketed. Question is how more loose can the straitjacketing be done? Is the only criteria here, and losing macro anchors once, regardless of whether we are in a once-in-a-century crisis or not, time will tell, are very difficult to get back. I mean, the same markets that are asking for some of these things will be the first ones to punish emerging markets, saying that you lost control. So I think that there has been flexibility, and that flexibility has been on account of relatively sound macroeconomic management, of which flexible inflation targeting has been an important support. So I think that I don't think we are in a situation where we should be contemplating throwing away a very important crutch for those emerging markets that have maintained relative price stability coming into the COVID crisis. I think it would be fatal to discard hard-won modern monetary policy frameworks that have come in place. After all, they came in place because what was before was not working, and I think it would be catastrophic if one were to do that.
Wonderful. Well, we're definitely over our time now. And I thank you everyone who joined us. Particularly thank you to the three panelists who took an hour out of their day today to do this. Thank you, Guillermo. And stay tuned. We have two more webinars coming up later on in the fall on global liquidity, one of them, interestingly enough, and lender of last resort. And one we hope we'll also be putting together on central bank digital currencies. So thank you all. I hope everyone has a good day.